You are listening to Wealth Talks, where we talk about solutions, money, and other things in your life. Have you ever gone to the store and bought a piece of clothing that you know is your size? You've been wearing that size for years. You get it home, and a couple of days later, you try to slip into it, and you find out it just doesn't fit. Well,
the size is changing?
That recently happened to me, John. I went to the store, bought a pair of pants. I've been 34 since I was in high school. Okay, get home, and I can't even hardly get the things anywhere close to being buttoned. And so I took them back and exchanged them for the next size up, thinking, well, there's just a size discrepancy here. Got those home, and they didn't fit. Finally, I just returned them and said, this isn't for me. And so I'm sure someone is listening today that says, is whole life insurance really for me?
Is it a good tool for building my wealth?
Is it a good fit? And what would you say to them?
Well, the answer is it depends. It depends on a couple things. It depends on product design and how you integrate it with your what you're trying to do with your financial future. And so, Mom, Michelle, you're here today. What would you say to people that are looking and asking, is life insurance a good tool for building my wealth?
Well, when I think about a good tool, I think about what we have in the drawer, what you have in your drawer at home, your tool drawer, or maybe it's out in your garage in a toolbox. What's a tool we all probably have?
A hammer.
A hammer, yes. And maybe you don't, and that's okay. Maybe you don't have need for a hammer at your house. But if we want to hang a picture, we need to go get a nail and pound the hammer in. Now, a hammer is a really good tool for that. But if I want to tighten a nut around a bolt, a hammer, well, it just
really
doesn't
help you with
no,
that.
it just doesn't cut it. And used improperly, a hammer can also create devastation. So if you've got someone who picks up a hammer and decides to bang out someone's window, that's destructive. And if you wanted that window out, I guess the hammer worked okay. But in most cases, we don't want the window banged out. So the hammer was used improperly. It's a good tool for hanging it, pounding the nail, but you do not want someone to go grab a hammer and bust out your window. So is it a good tool? Well, it depends how it's used.
Yeah. It depends how it's designed and how it is used. Absolutely.
And ultimately, does it fit?
Does it fit?
Because if it's designed improperly so that it's supposed to fit someone besides you, then it's probably not the tool you need.
That's right. And, well, there's different kinds of hammers too, right?
Absolutely.
I mean, I don't know how many hammers you have, Tom, for different kinds of tests, different kinds of claws on them, different weights, different sizes for different kinds of work.
So as a chiropractor, I used to have patients come in and they would say, they'd bring their spouse in and I'd wonder why. Well, why isn't your husband or your wife getting care? Well, they had already tried chiropractic. Well, there are a lot of different types of chiropractors, and what they do is different. And so you never hear someone say, well, I tried my medical doctor, and I just never went back because he just didn't do anything for me. So a lot of people say, well, I know all about life insurance. I had a policy one time, but they don't understand how we use it and how you can use it for being a very successful financial tool in your life. Otherwise, they wouldn't say that.
Yes, and part of when it comes to life insurance, it's a whole new field with new terminology. Where do you start if you're not familiar with the terminology that's used? We're going to be doing another podcast here soon about life insurance terms. We're going to make them easy.
Oh, I like making things easy.
Yeah. And today we want to focus on the system that we're using to manage your money wisely, the system you can apply to use to build wealth and how properly designed life insurance can fit into that. And that's where the Perpetual Wealth Code comes in.
And you'll be glad to hear that you do not need life insurance to exercise the Perpetual Wealth Code in your life. However, Why would you want to throw away the guarantees, the legacy, and the absolute control, and the saying goodbye to unnecessary taxation? That's why we use the life insurance in the first place. It's not that we wanted to be life insurance agents. It's that we realized that participating whole life insurance is such a great financial tool to allow you to avoid these things in your life that it would be silly not to look at it and see if we could find something that fits you.
That's right.
So really what we're talking to our listeners about today is how to be good money managers. And don't we all want to be good money managers?
Of course we
You have
do.
money in your pocket. You want to take care of it. You have money that you're earning. You have money that you want to see increase. We all can use better skills with money management.
Everyone listening today, you want to protect what you make. There's nobody that doesn't want to keep more of what you're making. And that is one of the reasons that we start with life insurance, because it is the sweetheart of the IRS code. How many times have we heard that, John, from attorneys, from CPAs, from people
More than
that
once,
understand the IRS code? Yeah. And so that is one of the reasons that we use it. It is such a wonderful tool to protect yourself from unnecessary taxes. And then once we begin to protect, then the second part of good money management, of saving, is automatic. Because when you buy life insurance, you have a premium. And we want those premiums to be converted as quickly as possible into equity. Now, the only product in the life insurance industry out there that produces equity is participating whole life insurance. Universal life doesn't do it. Term insurance doesn't do it. It's only whole life insurance that gives us equity. And participating whole life insurance allows us to add more equity when we share in the profits of the company, because we're participating in the profits that the company is producing.
Yeah, so there were some new terms maybe for those of you listening. We are going to cover those here in a future podcast. Right now, let's focus a little bit more on the 10-20-70 rule, which is the next step. How do we apply a plan for saving in our life?
Well, we like to use the 10-20-70 rule. And what we mean by that is you take your income that comes in, whether it's weekly, biweekly, monthly, whatever it is, whenever you get paid, you set aside at least 10% for your savings, 20% for paying creditors, 70% for living expenses, which we like to include mortgage and a car payment if you have one, in your 70%, because, hey, you gotta live. But that 10% at least should be yours to keep, yours to save.
You're probably thinking 10%. That's not going to get me anywhere close to the money that I need to sustain me in my retirement.
And you're right. You're right. 10% is not going to do it, but it's a great place to start.
Yes. I think of the story that you tell, where you were talking to this gentleman. He didn't think he could save 10%. He had 6 children, young children, still at home, and money was tight. But he said, okay, I'm going to try it. He put the 10% away. He called you a few weeks later. He was so excited on the phone. He said, I didn't even miss the money. It's amazing. It's there.
Yeah. And so if you have not established the habit of savings, every time you get paid, take at least 10% and set aside, even in your dresser drawer in an envelope. Just set it aside. It's right there if you absolutely need it, but you're going to build confidence in yourself as you start saving it and have an esteem that you didn't realize before if you haven't been used to saving. If you have been used to saving, then you know what I'm talking about, that good feeling of knowing that you're not spending everything you make.
Well, once you've established the 10-20-70 rule in your life, where it just becomes a habit to keep that 10%, then that gives you the control over money that you normally wouldn't have had control over. This allows you then to start recovering, is a good word, the money that you are losing on interest. Now, when you think of interest, you're probably thinking, well, maybe I don't have any debt. I don't pay interest to anybody. However, every penny that you spend, you lose interest on. That is the interest that we're primarily trying to help you recover in your life. Because it's been said that 9 cents of every dollar you earn is spent on interest. That's either interest lost because you had to spend the money or interest that you paid to somebody else. And so putting that 10% into your control allows you then to self-finance things, and your money does not lose that 9 or 10 or 12% or whatever it is in your life that you're losing right now.
Yes, that's one of the ways that you can use the savings, leverage it, if you will, once you have put it in a place where you can control it. And so many people in today's world, they think they are saving when they're actually investing, or they're locking their money away out of their control for most of their working life. So they don't get any benefit from it that they could be, while if we manage it according to this element of the Perpetual Wealth Code.
An example of that is, let's say that you're putting your maximum allowance into your IRA, $5,500 a year. And in year 5, you all of a sudden need some money. And you borrow from that IRA, which you can do for certain things. And let's say that you borrow $60,000. That $60,000 loan or withdraw, if you take a withdrawal, by the time 30 years is up, is going to cost you almost $600,000 of lost interest.
That's crazy.
And nobody tells you about that. They just tell you the rules that you can access your money, but you don't realize the high cost of interest it's going to cost you. If you borrow from that IRA instead of just withdrawing it, it's still, you're going to lose over $120,000 of interest over the next 30 years. So you have to back up far enough to be able to see the whole forest instead of just the trees when we're talking about money management. That's, again, why we use the life insurance. Participating whole life insurance allows you to access the money that is growing in your policy, the equity in it, without losing that compound growth. So you're not going to take a $60,000 withdrawal out of a life insurance policy because you realize it could cost you $600,000 over 30 years. You're going to take a loan, and you're not going to lose the growth on it when you do it.
So you'll pay some interest, but that's the cost of money at work.
That's the cost of money.
So you ought to be earning more or saving more interest than that when you take the loan. So very, very beautifully said. So then once we've taken care of debt, what else can we use that money for? And that now comes to the investments part. We could access that money to make other investments, couldn't we? Or couldn't you?
Well, that's a question that was asked at the Wealth Summit that we weren't able to address on the podcast there. And some of the things that we have invested in are we've helped people pay off a house that they started. We've helped people purchase a rental piece of property. We've helped people start businesses. We've helped people buy equipment for their business. We've done lots of different things. We've invested in our own businesses. We've invested in our children's businesses.
And I just want to say we've invested in our personal life as well, because I remember back in the day, we had a piano in the house. And we also had a baby in the house. And we had lots of people that wanted to play and practice the piano. And it was just where the piano was able to be located, it was just way too loud to have the people practice most of the time. So we went, have you ever heard of those? This was a really nice electronic piano, not a cheapo. It was top of the line Roland piano. You even had one of your patients who traveled around Europe playing the organ. He went and tried it out. He said, Tom, if I was blindfolded, I would not know that this was not a great baby grand piano. And so we purchased this electronic keyboard, and we used money from our policy. We set up a repayment schedule, and that proved to be a fabulous investment, because now some of my kids, one even got up at 5:30 in the morning, put on his headphones, and was playing and practicing and having a wonderful time while the rest of the house was sleeping. And so that gave great opportunity for people to realize our potential with music. We had no idea what was hidden in those kids, and yet I kept my sanity not having that blaring noise. So that was a very good investment for us.
Absolutely. So all investments don't have to be a monetary necessarily investment in that we're going to see a growth in money, but you're talking about emotional investments that money spent provides. And
Well, we're going to live anyway, and we are going to be spending our money anyway. We probably would have saved up our money and bought that piano anyway. So now we're just working on being better money managers, getting that money back into our control very purposely.
Yeah, and you didn't lose the compound growth when you bought that that piano, and that's the key. I think we're one of the benefits of the life insurance that we're talking about. Yes, life insurance in this way can be a great tool to help you build wealth.
If you've read Winning Your Financial Game, the book that we have written to help people understand how the perpetual code works, you will just understand that John was talking about the concept of both.
Yes.
Wealthy people never think, I want to take a vacation, but I don't want to give up the money. They say, I want the vacation and I'm going to keep my money. They never say, I'm going to buy an asset and get rid of my money. They're going to buy an asset and keep their money growing for them.
Yes.
And then when we learn and when you learn to think both like wealthy people, that's when you become more wealthy. We don't have to give up our money when we realize that we can keep control of it. That is what the participating whole life insurance policy does for us. That maybe, wealthier people don't necessarily have to depend on because they have other people's money that they're able to manage. But you and I, Michelle, don't have people lining up to give us their money to manage.
No, we don't. But, I am reminded of, not that long ago, we had somebody from the home office of an insurance company come and visit us in our office and say, hey, we have never before, wealthy people are buying whole life insurance like crazy because they realize what a fabulous financial tool it is.
Yeah.
So maybe some wealthy people don't need it, but a lot of wealthy people use it.
So I would like to tell another story here for you because many people mock whole life insurance. They mock insurance and say, you really don't need it if you manage your investments wisely. Well, there's a story about Liberty University, which has become one of the most renowned universities in the country now. It's got one of the best online course outlines possible. It's growing by leaps and bounds. It's in Central Virginia.
Lynchburg, Virginia. Yep.
Virginia. And Jerry Falwell founded that university, and it was in debt, $30 million during his lifetime. And they sold bonds and everything trying to get out of debt. And they built a Class A university, but they just couldn't get rid of this debt. Well, when Jerry Falwell died, he had $34 million of life insurance. And immediately the university was out of debt and had an endowment. So when we're talking about using life insurance, we're not just talking about how we can manage things today, but we're also talking about a legacy that we can leave that is absolutely tax-free.
Yes.
And it allows so many more people now, because of what Jerry Falwell realized his life was worth and took the time and the effort to make sure that he had the life insurance on it. Mm-hmm. He has made a huge opportunity for thousands and thousands of students worldwide to be able to get a Class A education at Liberty University.
That's amazing. So very quickly, if we were to round up all the benefits of life insurance, and this isn't necessarily all of them, but just a few of them. Number one, we have the protection.
Oh, yeah,
for
protection
young
on our
families
life.
especially. Number 2, you have the ability to leverage the money without losing the compounding growth. That's a great wealth building strategy. You don't have to jump through any qualification hoops to get the loan, the policy loan that we're talking about.
It's a signature loan.
It's a signature loan. You get the opportunity to participate in the profits of the insurance company, and we'll talk a little bit more about that. It's part of the participating part of the whole life insurance. And then we get the legacy that you just heard about, what that did for Liberty University.
There's one more thing that I would like to add to that, and that is when you do take a policy loan, it's an interest-only loan for your lifetime.
Yeah, no required payback time period.
So it allows you then to manage that money any place that it could save you more interest or make you more interest while you're paying a nominal interest rate, just the interest, not the interest in principal.
Yeah. So now we have covered some of the groundwork for the Perpetual Wealth Code and the life insurance. I have a few questions here that also came up at the Wealth Summit as we were covering some of the same information for people. So I wanted to go through a few of these here. One of the questions from the audience was, how many bank accounts does it take to do the Perpetual Wealth Code?
Well, how many hammers do you need to have to pound in a nail?
1.
So it kind of depends on, well, as a money manager, you have your checking account, most likely at your local bank. Now, if you're a business owner, most likely you also have a business account because it makes it easier for you not to commingle the funds.
Yes.
So when we
important.
talk about being a money manager, we also like to think of having another personal checking account that we use for our money management. And we do have a system that we teach people how to use that within their whole scheme of things, their personal account, their business account, their money manager account. And it doesn't matter how, some people have multiple policies on their own lives, their spouse, their children, but you only have to have one money manager account because you're just one money manager, right?
Well, think of it this way. You're wearing a hat right now as an income generator.
Aha.
You're wearing a hat as a bill payer. Mm-hmm. Maybe you're wearing a hat as an investor. You're going to buy a whole life insurance policy. That's a hat as a policy owner. Now you put on the hat as a money manager. And you only need one business account, one personal account, and one money manager's account. And so you could have more than that if you wanted to.
Yeah,
But
I mean, if it makes it easier, but you don't want to add unnecessary complexity.
That's right.
That's right. So it kind of depends on what you're doing and how it makes sense to you.
Very good. Very good. Another question that came in from David at the Wealth Summit. He said, can I borrow from a source to pay my policy, to start a policy, and then borrow from the policy to pay the loan back?
That's called premium finance. That's another one of those big terms that we're going to be talking about. And premium finance means that you're financing your premium and paying interest to somebody else to pay your premium.
Yeah, there's an interest cost.
We don't advocate that for individuals or small business owners because it destroys the growth then that you're going to experience in the policy. So when a policy starts out, it's a baby. It's growing slowly. And the interest that you're paying to somebody else, if you've borrowed that money to start the policy, could even deter that growth even more.
Yeah.
So that's not something we advocate. It could be done. We have borrowed from a home equity line of credit in the past to pay a policy. I wouldn't recommend it for anybody, okay? But in a short-term period, if cash flow is going to come in the income column someplace, it could be a
good strategy.
It could be a good strategy.
Yeah.
So we're not saying a blanket, no, absolutely not.
Yeah. You just don't want to get behind the 8 ball.
There you go. And we're not saying a resounding yes. Again, we go to the 10, 20, 70, 10% at least, what's comfortable and affordable. If you've got savings where you can jumpstart it, hey, that's a great idea too. Sometimes people come to us with a lump sum. Maybe they've just sold a house. Maybe they've got an inheritance. Who knows what's happened. And we work on designing the policy based around those figures. So, but to go and borrow and to create extra interest payment for yourself, that's actually taking you into the negative instead of building wealth.
It could violate the first two rules that we have for you, and that is your premium has to be affordable and it has to be comfortable. So if someone comes to us and maybe you've just sold an asset, you have a lot of money, or maybe you won the lottery or whatever it is, and you've got a lump sum, we're going to help you structure to get that money into a policy. But when that money is gone, the premium that's left has to be affordable and comfortable for you. Otherwise, you have not been provided a service, because it's going to cost you and end up costing you money.
Yeah, good. Very good. What? This is another question that came from somebody at the Wealth Summit. What are your thoughts on transferring 401k money to policies?
So transfer.
So because obviously with the 401k, that money's locked away. You can't
Right.
use it with the Perpetual Wealth Code that we were just talking about. I mean, maybe you can get a loan for limited cases, and it has to be paid back within 5 years. But overall, can you provide us some insight on that?
Well, the 401 represents the section 401k of the IRS code.
Yes.
And it's an exception to the taxation rules that we're allowed to defer taxes on money that's put into that account until we're 59 and a half. And with that rule, it says that if you access that money before you're 59 and a half, you're going to pay a 10% penalty. Plus, then you're going to pay the income taxes on it that you deferred.
Yeah.
So we have to be really careful when you're accessing 401k money that you're following the rules, that you don't end up getting penalized this 10%, because that's hard savings that you've put aside. You don't want to lose it. So in some situations, in my own situation, for example, when I was 45 and I knew that I was going to take this money out of my 401k and I was going to put it to work and we were going to make it grow, it made sense for me to pay the 10% penalty,
Yeah.
John.
So you were going to make more than the 10% back.
And so,
Yeah, there's
again,
the
this
key.
is on a case-by-case basis that we would talk to you and find out what is your potential, what is your ability to make that money grow when it gets under your control. And if it's limited or you don't have a plan, then it may be better for you just to let that money ride until you're 59 and a half, so you don't have to pay the... Now,
And we'll never tell you to take it out. We can look at the numbers with you, but you'll know ultimately whether that's the right decision for you or not.
And here's another limitation. If you are still working for your employer where you have the 401k, you can't touch it. Not until you lose your job or quit your job. So that just has to stay there. Now, do you have to continue to make contributions? Most likely you don't. I have heard of some cases where there's mandatory contributions, but most likely you can stop contributing any more to that fund. And hopefully that fund will go ahead and ride the wave and still be at least the value that it is now when you're 59 and a half and can do something about
and
it.
maybe you'll continue contributing to get the employer match. I mean, there are different combinations or options out there.
That's right. And again, we look on a case-by-case basis, because your 401k may be different than anyone else's 401k. And liquidating your 401k might put you in a higher tax bracket. So if you decide you do want to liquidate, maybe there's some strategy to that. Maybe not all in 1 year, maybe over a period of years. So you don't have to pay as much tax as you otherwise would. You want to be smart with your money.
that's a strategy that may apply to you after you are retired, or if you have a widowed 401k where you no longer are employed by the person, the company that started your 401k, then it could work where you take distributions from that 401k over a period of time to keep yourself in the same tax bracket so that you avoid the required minimal distributions that will affect your tax rate once you turn 70 and a half. And that can be a strategy that we help people walk through as well, John.
Yeah. So there's one more question I would like to at least touch on before we wind up for today, and that is, what about for those of you listening who maybe only have 5 to 10 years of full-time work left, you're getting close to that quote retirement age. Can this strategy, the Perpetual Wealth Code, using the life insurance, can that still work, and how? Because we've been talking, a lot about the accumulation phase today, but what about when we go and start spending money, using it for the passive income?
Well, again, this depends on how much you've saved up to this point, because whole life insurance isn't magic. It takes a while for it to work. We often compare what we're doing to Aesop's fable, the tortoise and the hare. We're the tortoise. We're slow and steady. We're going to win the race because we have consistency, guarantees, and a security on our side. But at the same time, if you come and you only have 5 or 10 years left to work and you haven't saved anything up to this point, well, using the Perpetual Wealth Code will make your life better for the future, but it's not going to provide all of what you need to sustain your living once you retire.
There you go. Great answer.
Yeah, I was going to say that is a great answer. And we are getting to the end of our segment today. And I'm just thinking, along with you folks out there, as you're driving or as you're working or working out or whatever you're doing while you're listening to the podcast, I'm just thinking that we have covered a lot of terms.
Sure have.
We have covered a lot of concepts. We have talked a little bit about a lot of things, but not in super detail. And it's reminding me of the client that we visited with this week. He wasn't a client when he contacted us, but he said, "Yeah, I've been listening to your stuff, or I've been watching your stuff, and I am getting information overload, and I think it's just time to talk to somebody." And sometimes that's the best thing to do, because there's a lot of questions out here that maybe don't pertain to you, or maybe we just haven't spent enough time on that one thing that is really going to help you figure out, is life insurance right for me? Is it really going to help me build wealth? And I would just encourage you to just give us a call, and we'll talk, and we'll just be candid and discuss together how this might work for you, and we'll see if it will work for you, and you'll be able to look at that and try that pair of pants on before you actually buy it and see if it's the right size.
Very good.
Michelle, I just have to tell this story before we end, and this was years ago. There was a shoe store in our town that always said, "Come in, ask to be size, fitted."
Yeah, don't ask for your shoe size.
Always ask to be fitted. Mm-hmm. Don't ask for your size. Always ask to be fitted. And then on Father's Day, they had an advertisement where all you had to do is come in and tell your father's size, and they'd give you a pair of shoes. That's not the way we work at Life Benefits. We want to make sure that you are fitted, because each of these products are designed for your special needs, and we need to have that conversation just like we did with this client, so that you know exactly what you want.
Yes. So give us a call to get that strategy session scheduled. 702-660-7000. We'll be here ready to help you. So until next week, you are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. Have a great week.